Good afternoon, everyone. A pleasant good afternoon. Welcome to this evening's webinar entitled Financing Your Home Ownership with SECU. My name is Asha Baksh, and I'm the Finance Manager of Cannings Employees Credit Union, and I will be moderating this evening's session. Today's webinar is focused on educating our members on SECU's mortgage process and providing guidance on how you can acquire your dream home. Before I introduce our presenter, please allow me to share our house rules. Firstly, please know that all mics will be muted throughout the presentation. At the end of the presentation, we will have a Q&A session whereby you can ask your questions. During the Q&A segment, if you have a question, please click the raise your hand button and your mic will be unmuted for you to speak. Alternatively, throughout the presentation, if you have a question, you can type it in the chat and we will address it at the end during the Q&A segment. Today's session is expected to run for approximately 1 hour and a half. This seminar will also be recorded and uploaded in the library section on SECU's website. So I take great pleasure in welcoming our presenter, Mrs. Kellyanne Trabuley Hack, who is the General Manager at Cannings Employees Credit Union. Mrs. Trabuley Hack has over 20 years' experience in the financial services and property development sectors. She joined SECU as the Finance Manager in September 2013 and subsequently assumed the position of General Manager in 2017. Kelly serves as the ex officio on the Board of Directors and all committees, and her experience includes key areas such as finance, marketing, and credit. Kelly possesses a master's in business administration from the Heriot-Watt University and is both a member of two accounting bodies, ICAT and ACCA. So a special welcome to you, Kelly. And at this point, I now hand over the session to you.
Thank you very much, Asha, and good afternoon to all our members who are joining us today. Thanks for logging on to the session. So this evening, what we're going to be looking at is financing your home ownership and doing so with SECU. So I am going to share my screen for the presentation. This presentation will also be saved on our website, so that you can always refer to it later on. So let me just get a presentation up and then we can begin. So I know that we would have, in terms of the demographic of our members logged on today, we might have members who are in the planning stage. We have, or, now thinking about maybe, this is something you want to do. Then we may have members who are kind of already midway through and be like, okay, I'm ready to take this mortgage. So we're going to be touching on a few topics. Oops, I'm too far back there. Just give me a second. Okay, all right. So in terms of what we're going to be covering in this evening's webinar, we're really going to look at the planning stage. So those who are now thinking about home ownership and not yet at the stage where they are ready to do a mortgage application, but you are planning to get to that stage. And inside of that planning for a mortgage, we're also going to touch on budgeting, which is something that it's a key thing that needs to be done when you are planning for a mortgage. Even when you have taken the mortgage, budgeting is ever so important. So we're going to be looking at that. We're going to be touching a little bit on the property search and then spending some time on the actual mortgage process at SECU, which will include looking at the documents that we generally ask for. We will also look at a few different scenarios in terms of what an installment would look like over various terms. And then we're going to talk a little bit about why SECU, why choose SECU to finance this very big investment in your life. So when you are planning for a mortgage, and let me backtrack by saying, taking a mortgage or even starting to think about taking a mortgage, it can be a very, very daunting process, because it's not as simple as, you know, just taking a personal loan or even taking a car loan. A mortgage loan, you're talking about a huge investment, and for a significantly long period. On average, mortgages can run anywhere up to 30 years. Even, I mean, one particular financial institution now is offering 40-year mortgages. So you're looking at sometimes half your life tied into financing a mortgage. So that it can be very, very daunting thinking about that, not just the length of period, but also the amounts of money. Now, when you're in the planning stage, so you know that home ownership is one of the things that you want to achieve in your life. And you're looking at, okay, how do I get to that place? How do I get to that place when I apply for a mortgage, I get approved and I own my own home? And it starts with the planning. And in that planning, you have to know what you're working towards, and you know, what's the first step? One of the first things is working towards your down payment. Now, the term down payment sometimes is kind of used loosely, but it really refers to two aspects. And that down payment, which can be substantial depending on the value of the mortgage, that down payment refers to two things. So it's the 10% of the purchase price of the property that is handed over to the vendor to secure that property. And that's something that's usually paid when the sale agreement is signed. So let's say the cost of the property is $1.5 million and your offer has been accepted. Then when you sign that sale agreement committing to buy that property, you've got to hand over a check to the attorneys for $150,000. And that is, it's not deposited, it's held in escrow until the mortgage is closed, but that is securing that you're going to buy that property and nobody else will be given that chance for at least the next 90 days. Then down payment also refers to the amount that you need to have within the financial institution in order to apply for a mortgage. So that there is a 10% requirement, but this 10% is based on how much you are actually borrowing. So if you are borrowing to finance the full purchase, so if you're using the 1.5 million, it means having 10% of that on your shares, which forms part of the collateral, right? So the down payment itself, that's the first thing when you're thinking about taking a mortgage. The first thing you need to start planning for is your down payment. Do I have my down payment? How am I going to get my down payment? How long do I have before I need to have my down payment, right? Because notice the figure I quote. So when you look at property prices right now, you're not really getting a lot of, I want to say good properties under the $1 million range. A lot of the properties you see coming in at 1 all the way over 2 million. So when you're looking at 10% of those figures, you're looking at anywhere from 100,000 to 250,000 to 300,000. So your down payment is actually a substantial amount. And that's why this whole process sometimes is a little daunting, because it's a large figure that you need to work towards before you even get to the mortgage process. So down payments can be obtained in various ways. There could be an inheritance, or it is gifted. You know, you do have instances where gifts, when you get married, between the parents, the in-laws, all of that, you get gifts and it totals your down payment. Sometimes even you have someone who has passed away and they have willed money to you, things like that. So your down payment could come up through inheritance. You can have assistance from parents, from your family, who are willing to help you with that down payment. You're financing the monthly mortgage payments and all of that. So you're taking the mortgage, but you have parents or family that are willing to help you get started. You have instances where the down payment is acquired through the sale of an asset. So there are instances where, for example, you have a husband and wife that own their own cars, but maybe have changed employment and now it's company cars. So they're able to sell the vehicles originally owned, and that money can then go towards building that down payment for mortgage. So sale of assets can work. And then you have the just accumulating savings over time. Now, 85% to 90% of the cases, it's accumulating savings over time. It's the very few where you have the inheritance and the sale of the assets. We do also see a lot of instances where parents are helping their children. So they're helping with the down payment part. And then the child is able, when I say a child, the young adult, the adult is able to then apply for the mortgage and take the mortgage and finance their property themselves. So the first thing that you need to start looking at is, how do I get to my down payment? What do I need to do to get to my down payment? That requires planning, right? And you've got to set some timelines because you have to be realistic about it. At the end of the day, and I mentioned it before, a mortgage loan, it spans sometimes half your life, right? So it could go from 15 years all the way up to, as I said, one financial institution goes all the way up to 40 years. So you have to do a little working around to figure out what's the latest I can take this mortgage and how long do I have to come up with my down payment, right? Because what you're doing is when you're thinking of your down payment, what you're thinking of more is not necessarily the 10% to pay the vendor, as in the seller of the property, but what you should be focusing on is accumulating that 10% to place in the financial institution so that you can then apply for your mortgage, right? The other thing you want to look at is, what's the deadline age by which you want to have your mortgage application in? And that is really, really important because you've got to remember retirement age. Right now, nationally, retirement age is 60. There's a lot of talk about it moving to 65, but currently it's 60. So that a lot of financial institutions use that as that cutoff, the 60-year cutoff. So how long do you have before you're ready to apply for that mortgage? So you have to ask yourself a few questions. So what's the retirement age in my place of work? Is it 60 or is it 65? We have a lot of organizations right now where retirement age is 65. You have the option to retire at 60, but you can work all the way to 65. Then what's the latest stage that you want to apply for your mortgage? 30, 40, 45. What is your age now? How long do you have to save up for your down payment? And that's based on the questions that were just asked and the answers given. Because essentially, and I have a little table here that kind of puts it in perspective. So let's say that you're currently 30 years old and you want to apply for a mortgage by age 40, and retirement age where you work is 60. It means you've got 10 years to play with in terms of accumulating your down payment, and then you've got 20 years to pay off your mortgage, right? But let's move along a little bit. So you're currently 40. And you say, okay, I'm giving myself 8 years. By 48, I'm applying for this mortgage. I'm going to own my property. Retirement age is still 60. It means that you have less time to accumulate your down payment. You've just got 8 years to play with. And then the duration of your mortgage also is shorter, 12 years. If you're currently 45 and you say, okay, by 50, I have to own my own home. I have to put in a mortgage application. Things have to be in place. Retirement age is still 60. It means, again, you've got less time to accumulate your down payment and even a shorter mortgage duration. And I put that in so that you can see the longer you take to accumulate the down payment, the shorter your mortgage period. And then what happens, the shorter the mortgage period, you find the higher the installments. So those things are little reality checks that you need to be aware of. And what we are seeing a lot more is that the average age of persons taking mortgages right now or being ready to take a mortgage, not that they're not thinking about it, but being ready to take a mortgage, it's actually in the mid-40s you're looking at right now. The accumulation of the down payment, the savings towards the down payment and all of that is happening from like your mid-30s into your early 40s. And then around your, and I would say still early 40s to mid 40s, then you're saying, okay, I'm ready to take a mortgage. So you actually find the average mortgage duration falling between like a 20 years. Sometimes you get a 25 years, but it's on average 18 to 20 years because persons are waiting a little longer. And it's not out of choice, it's actually because you're saving up towards your down payment. So sometimes the saving towards the down payment does take a little time, but it is something that needs to be done in order for you to be ready to apply for that mortgage to be able to own your own home. Now, accumulating a down payment, it requires discipline. Because if you remember, when we look at this slide here, we're seeing, look at the number of years we're looking at to accumulate your down payment. And this is assuming you don't get an inheritance, you're not, you don't have family that's helping, you don't have an asset that you can sell. So this is just you saving towards your mortgage down payment. You're talking about 5 to 10 years sometimes, depending on the amount that an individual can save. A mortgage is probably one of the biggest decisions that you're going to make in your life. It is huge in terms of value because you're looking at, as I said, mortgages right now, it's between $1 million and $2.5 million on average. That's a substantial investment that's being made, as well as it's a long duration. So that working towards that, it requires discipline, it requires budgeting. You don't come up with 150,000 overnight, and I'm just using that as a figure. What helps is setting a budget. Again, giving yourself a reality check to see realistically how much you can save every single month. And what you do, you can use this simple table. And it's an income and expenditure sheet. And what you're looking here is at the household income. If you are a single person or in a household with just one solid income, so it's just going to be one income captured here. But if you're in a household where you have a husband and wife that are both working, so you have both incomes coming in, then you can combine it to see what out of the household income can we comfortably save every single month. So you're really taking what is your monthly income, and that's essentially how much you're being paid every single month, not what you're getting into your bank account, what you're actually being paid. You could include additional income. A lot of people have side businesses where additional income is applicable. Include the additional income. Then back out all the statutory expenses. And when I say statutory expenses, those are the expenses you don't have any control over. Some of them are legal expenses, and not legal, but mandatory, statutory. And then some are by virtue of being with the companies, insurance and stuff like that. So tax, PAYE, NIS, health surcharge, those must come out. That's not discretionary at all. Then in most companies, once you're a permanent employee, you have contributions to pension and you have got contributions to health and life insurance. Generally, it is a situation where the employee contributes part, the employer contributes part. So you find that section, you don't have a lot of control in terms of cutting back here or cutting back there. Those have to come out. So you take those out. Then you look at your other monthly expenses. And this is where things like rent will come in. If you are living with family, then you may not have rent, but you may have to contribute to the household, or you might be renting, so that has to come out. You may have loans, you may have credit card payments, that's got to come out because those must be paid every single month. You've got utilities, you have to buy food. If you have a vehicle, maintenance of the vehicle, gas. If you don't have a vehicle, then transportation. So all of those things are now your living expenses that have to be taken out. And then what is left is really your net income. Out of that figure, you can then figure out how much can I comfortably put aside every single month. Because what you are trying to do here is discipline yourself and kind of create a habit. So you don't want to say, okay, I have $2,000 extra every single month. 1,000 of that I'm going to put aside in savings without being absolutely sure that you're comfortable with that. Because what you don't want to do is every month change the figure. You want to set it up so it's a set amount coming out every single month. If down the road you have extra that you could put aside in savings, great. Because what you're trying to do is build a habit. And that's the discipline because you're going to be doing it consistently. Now, I find one of the easiest ways to save diligently is by using a salary deduction. So those of you who are employed with our member companies, you have the option of setting up a salary deduction. That way, a certain amount is going to come out every single month without you even seeing it. And it comes down to the credit union and we put it on your shares. So you're not even seeing it. When you don't see it, when you don't get it in your bank account, it hurts less. You don't feel that it was ever really there. When it kind of goes into your bank account and you have to take it out and send it somewhere, sometimes it pains you. So the easier way is set up a salary deduction or set up a direct debit so that it automatically just comes across. And that way you're not able to touch it and you can diligently save every month. But it should be a realistic figure because again, we do not want that you are budgeting down to the last cent and saying, okay, all of my money is accounted for. You always have to have that little emergency in case, what if? But you save diligently in a pattern towards your down payment. So these are some little scenarios here in terms of it's really savings plan scenarios. Again, working towards getting to your down payment. Now, one of the most common questions that members tend to ask when they're doing consultations with me is how much do I qualify for? Because you're not going to know what down payment you need unless you know what's the average amount you want to borrow. So one of the first questions is how much do I qualify for? And then that will help you figure out what's the down payment you need to have, right? So essentially, and you can go to our website to use the mortgage calculator as well because you're playing around with the figures. So essentially how we do it is you kind of work it backwards. You look at the household income. And again, I say household income, not the individual's income. So again, if you are the sole breadwinner in the family, it is only one major income, then that is your household income. But if you are in a household where there's a husband and a wife and your income, the two incomes are together, then that becomes the household income. You take the gross household income and you calculate 45% of that. So in here, we used an estimate here for a household where total income is $18,000. And what we did is household income $18,000, and we took 45% of that. 45% because that's the average debt service ratio. Debt service ratio meaning the amount of your gross income that your mortgage payment represents. So most financial institutions use between 40, maximum 50 if you're really going down to the wire, 50%, but it's usually between like 40 to 45% of gross income should represent a mortgage payment. So right away, you take your gross income and you take 45%. So assuming this household is $18,000 gross income, not the amount you get in your bank account, but the actual amount you're being paid, right? Before taxes and all of that. 45% of that is $8,100. So an installment, a mortgage installment, shouldn't be more than $8,100 based on your income. And that's when we kind of, you kind of work it back, and you can actually go to our website, www.mysecu.com, and you go to our loan page. There's a mortgage calculator right there, and you can actually play around with the figures to tell you what installment will come close to $8,100. And so when I played around with this myself, we're actually looking at $1.2 million. Right? Of course, that's assuming a specific time period and all of that too. So using $1.2 million. If you want to take a mortgage for $1.2 million, it means you have to have a down payment of $120,000. So using these scenarios from the last slide, the different age groups. So if you are 30 years old now and you want to take a mortgage by age 40, it means you have 10 years to play with. And if you have to accumulate $120,000, it means every year you have to save $12,000. That's $1,000 a month, right? If we look at age, you're age 40 now, and you want to take a mortgage by age 48, it means you've got 8 years to play with. It means you need to save, using the same 1.2 million, you need to save $25,000 a year. You break that down monthly. If you're 50 years old, and you want, 45 years old, and you want to take a mortgage by age 50, that's 5 years you're dealing with. It means that every single month, you need to save about $2,000 a month, right? So again, it goes back to the longer that you take the mortgage, the more you need to save every single month. But at the end of the day, the saving, it requires discipline and consistency. Now, when you're saving towards your down payment, we encourage members to put your money where it's somewhere safe and where it is providing a good return. And when I say return, I'm talking about interest, or in our case, at Secu, dividend, because you want your money to be working for you. If you're saving towards a down payment over the course of between 5 to 10 years, that's a long time. You want your money to be growing, right? So a perfect example is right at your credit union. You can send that money to your shares every single month, and every year you get a dividend. Over the last 5 years, the dividend has averaged between 3 3/4 to about 4%, and that dividend goes back onto your shares and then earns more dividend. So be careful where you put your down payment. I encourage our members, if you're saving towards a mortgage, do it right at your credit union and at least maximize the return and know that your money is safe. Yeah. So once you've got the down payment in place, and you can start this one, you can start the property search even before you have the full down payment in place. The property search is not, this isn't a quick process. When I'm talking to members, especially members who they're not ready to take the mortgage yet, they're just, having an exploratory conversation with me in terms of what to do, how to plan, those kinds of things. I encourage members, take as long as you need to search for your property. It's not like buying a pair of shoes. It's not like buying a car. This is going to be your home. It's going to be where you live. You have to know what you're looking for. Ask yourself some questions. And of course, you're asking yourself these questions after you've figured out what you can afford, right? So the planning and the budgeting helps you to figure out what realistically you can afford, to pay in terms of a mortgage, right? When you know that, then you can start to look for property, because it wouldn't make sense starting to look at property before you know what you can afford, because then you might be looking at things that you can't afford, and that won't make sense. But ask yourself some questions. What is it that you want? Do you want a standalone house? Do you want an apartment or townhouse style? Gated community, no gated community? What areas are you considering living in? Do you want somewhere that is pet friendly? You want a brand new move-in, everything perfect home, or are you willing to go with a fixer-upper that might be a little less costly, and over time you can fix up to exactly how you want your home to be? What's the commute time to your office? What's the kind of security? How secure is the neighborhood? Because I mean, that is something that, especially in this day and age right now, with the crime that we're seeing taking place, a lot of people are very concerned in terms of where they're living, how secure it is, and those kinds of things. We are seeing a lot more developments actually being constructed. So before, developments used to be just townhouses or apartment style living, but there are a lot more developments that are coming up where it's a combination of the two. So it's a gated compound, but on that compound you've got standalone houses, and you've also got the townhouse style or apartment style housing as well, but all in one gated area. So it's kind of giving consumers that option to still have that gated, secure, safe area, but you can have your standalone or you can have your apartment style. So you've got to ask yourself all these kinds of questions. I mean, that question about commute time to office is always a big one, because if you're working in the Port of Spain area and you want to live close to where you work, know that the price that you're going to pay is a lot higher. Whereas if you're living out of the city and you're living more like central, even south, cost might be lower, but then that commute into office is going to be longer. So all of those things you need to figure those things out before you start looking, because that way you have an idea as to what you are looking for, right? Register with reputable realtors. There is no cost to that. For the buyer, it is totally free of charge. It is a cost for the seller when the property is sold. They have to pay a commission to the realtor. For the buyer, there is no cost to registering. So register with many realtors. You will get subscribe to the email listings. You will get emails of listings and all of that to see what is out there. You can also look at reputable websites. So mybunchofkeys.com is a very reputable website. A lot of the realtors list on that website. They cover rental, they cover land sale, property sale, all of these things. So that is actually a very, very good website that you can look at in terms of property search. But don't rush the property search. Look at places. Don't pick the first one. Go and look at quite a few places. I remember a realtor was doing a presentation at one of our mortgage seminars. This is pre-COVID, when we had a few face-to-face mortgage seminars. And they said, drive around the neighborhood at night. So you go to see a property and you think, oh my gosh, I really love this one. Take a drive at night, because that way you're able to see the lighting in the neighborhood. You're able to see if it's a lonely area, if people lying on the corner, or those kinds of things. Drive around, talk to the neighbors, all of those things. Always remember what is your budget. View properties within your budget. In recent times, I've realized through having consultations with members that a lot of the realtors now are asking for pre-approval letters. So before they even allow you to view the properties, they're asking for pre-approval letters. And it is something that we do provide to our members. Our pre-approval obviously is very conditional. So we would pre-approve you based on your ability to pay, but it is always subject to all the documents being in order and subject to the approval of our credit committee and the commissioner's office and all of those things. So it's a conditional pre-approval that we give because we recognize that realtors now are asking for that before they actually engage with customers to allow them to view properties. So that's something, and actually in the pre-approval, when we're doing the pre-approvals, it also gives you a sense of what you can afford. So it does give you a little reality check as well, all right? What we're gonna look a little bit at now is the mortgage process. So this is the mortgage process at SECU. Choosing your financial institution is really, really important. Again, I mean, I can't say enough. It is the biggest investment that you're going to make. It's probably one of the biggest assets that you will acquire in your life. It is something that you will be tied in to paying for sometimes half your life. And the institution that you choose to partner with to obtain this asset is really, really, really important. I tell members shop around, no problem, because it's a huge investment. Go ahead and shop around and check the commercial banks and check everywhere. And that's because I also know what a wonderful product we have at SECU. So I'm not afraid to tell members, go shop around. That's fine. But it is important to really sit down and think about which financial institution you're going with, because you don't just want to go with a financial institution because the interest rate looks nice. You want to go with a financial institution where they're going to take the time to sit down and go through the process with you, that they will hold your hand through the 90 days all the way to closing, because it is a daunting process, especially for persons where this is the first time that they are looking at purchasing property. I've dealt with quite a few members that, you know, have literally held their hand straight through on call through the 90 days, explaining things to them, and they were so appreciative after, because they said, you know, a lot of the stuff, especially the legal things, they didn't understand, and they appreciated having someone to talk to and explain. You want to have that. You want to have someone who has your best interest at heart. That is not just about the money. It is about helping the member to get that dream home. So again, be careful with where you look to finance your mortgage. I will tell you that there is a lot of aggressive advertising that takes place. This is before I go into our mortgage process. There is a lot of aggressive advertising that takes place. I mean, you open the papers, you listen to the radio, you put on the TV, even all over the internet, you see the commercial banks, you see other institutions giving mortgages, and they throw these very, very low rates at you. And they also throw things like, you're going to get cash back here and cash back here, and you're getting this off and that off. I will tell you that banks never give you anything free. They might tell you that, but they're going to get that back somewhere along the life of the mortgage. That's all part of the advertising. There is this clause within every loan agreement, and we at Cannings have it as well, because it is a standard clause in every single loan agreement, and it is called the variable interest rate clause. What that allows an institution to do is to change the interest rate if need be. As I said, it's a standard clause that's in every financial institution's loan agreements. But what happens with commercial banks and other financial institutions too is that they catch, and I say catch because it is aggressive marketing. So they kind of catch you with the low interest rates, and we're going to give you 15,000 cash back and 20,000 cash back. And they give it to you in the first year. And then on the anniversary of the mortgage, they actually invoke that variable interest rate clause and take the interest rate up. And then that continues happening so that every year you're paying a little more, a little more, a little more. And then what happens is they've actually recovered all the money they gave you up front and then some, because they keep taking the interest rate up. And you end up paying a lot more in the long run. Canix does not do that. We've actually never, we have the clause in, we've had it in since we launched our mortgage product in late 2013, and we've never raised our interest rate. We've actually lowered our interest rate over the years. So we're very upfront about, what is in our agreements. But that is something that a lot of customers, a lot of members get caught with the banks. They get caught with the interest rate, they get caught with that cash back, and then on the anniversary, literally 1 year after they've signed with the bank, they come back. Gosh, the interest rate has gone up. I'm paying more. Is there any way I can move my mortgage? Once you sign with the commercial banks, within those first 5 years, moving your mortgage to another financial institution could be very costly. Because 1, there'll be penalties. 2, you're going to have to do a valuation again, do legal fees again, all of that to actually move a mortgage. So you've got to be really, really, really careful before you choose your financial provider. Okay. So in terms of the mortgage process, the very first part of the mortgage process, and it's probably the most important part of the mortgage process, is booking a consultation. So you book a free consultation with me. And in that consultation, it's a discussion. Sometimes the consultation could go from 30 minutes to 45 minutes, depending on how much discussion and what we're talking about. Sometimes it goes longer, but it's a free consultation where I have that conversation with the member, and it's really the opportunity for me to understand what you as the member are looking for, and for you to explain what it is you're looking for. Sometimes in the consultation, the member is ready, you have your down payment, you selected your property, and we go straight to the searches and valuation. And then sometimes the consultation is helping the member figure out what it is they want, or brainstorming sometimes in the consultation to figure out, okay, this is what you want to do, this is how you can get there. Sometimes in the consultation, unfortunately, the member doesn't get the answer that they would hope to get. And, it's something where we don't like to put members in a situation where they can't afford something or they get themselves into a hole. So that in the consultation, if it is a situation where at this point you're not ready to take that mortgage in terms of, you're stretching yourself too thin, we tell you that as well, and we guide you. So it's a very in-depth consultation, but it will cover everything from looking at the deposit to discussing the interest rate, the repayment terms, your debt service ratio, looking at what you could afford if it's an exploratory conversation, so you haven't had, you don't know what you want to purchase as yet, and you're looking at what you could afford. We look at those things, and then we talk about the mortgage offering and then general guidance. So it's the first step in the process, and it's the most important step in the process because it gives the member an understanding of what we can offer as well as what the process is. So I encourage members all the time. Sometimes we get calls from members that I'm interested in taking a mortgage, so I want to do the application, or I want to get this done, and we have to tell them, no, you've got to book that consultation first, because sometimes in the consultation you realize, okay, what I thought I wanted to do or what I wanted to do, I'm not able to do it right now, or I may have to adjust it and whatnot. So that I can't stress enough having that consultation with me first. Once the consultation is done and we've established that you have your down payment in place, established that you've selected the property, or you've found somewhere that you really would like to purchase, it's looking at the sale agreement. So we do advise members not to sign any sale agreement until after it is reviewed by an attorney. Now, you as the member, you have the right to have your own attorney to review your sale agreement. Alternatively, you can have our attorney, as an attorney who represents credit union, review for you, and then that becomes part of your legal fees. But it is really important to have that sale agreement reviewed. And the reason being is that when you sign on the dotted line, you are then bound by whatever is in that agreement that you've got to purchase this property in the 90 days. And so we advise members don't sign any sale agreement until after title search and valuation is done, because the title search will tell you that the property is free and clear. There are no encumbrances, and you're free to purchase it. The person who's selling it is legally entitled to sell. And then the valuation tells you what's the value of the property. Because we've had instances where, and this has happened for land, not so much property, but land, where the seller is asking a particular price, but when the valuation is done, the value of the land is less than what the seller is asking. And that then becomes, that impacts the mortgage, because as an institution, we won't lend, we wouldn't lend more than what the collateral is worth. So the title search and valuation are very, very important, and we encourage members do not sign a sale agreement until title search and valuation are done. Now, the title search and the valuation can be done by our attorneys and one of the valuators on our panel. These would be for your cost as well. But again, those are two of the things that have to be done first before we even think about an application, okay? Once the search and the valuation are in order and the sale agreement, when reviewed, everything is okay in there, we give the green light to, okay, go ahead and sign that sale agreement. Remember at the beginning of the presentation, I spoke about down payment being two different things. The 10% that's paid to the vendor to secure the property, and then the 10% that you've got to have in the financial institution. So it doesn't mean that you need to have 20%. It really means you need to have 10%. So that the 10% that you have in the financial institution, once the title search and the valuation are in order, and we give you the green light to go ahead with the sale agreement, we would give you a 90-day secured bridging loan to pay the vendor. And we secure it against the 10% on the shares that you have in the credit union. So what that essentially means is that we're advancing 10% to you to pay the vendor, and when the mortgage closes, we then pay out the remaining 90%, right? So that way you're not out of pocket money at any point in time. Once the sale agreement is signed, then we go to the mortgage application. We go through the whole list of documents, which we would look at today, all the different things that we ask for that are required for the application. Put that together, prepare your application, and it's presented to our credit committee for consideration. Now, before it's presented to the credit committee for consideration, what we started doing about 2 or 3 years ago was having an interview with the member. So it's part of the process that you have that interview with the chair of credit and myself, so that we can just have that discussion in terms of you taking the mortgage and, little things, COVID taught us a lot. in that have backup plans in place. Because when COVID came in that first year and even in the second year, a lot of persons lost their jobs, laid off temporarily, furloughed, all these different things, and income was impacted. So that you had situations where persons couldn't afford to pay their loans, they couldn't afford to pay their mortgage, their car loans, things like that. So part of the process now is having that discussion with the members so that we are comfortable that, you know, you've also got savings outside of the credit union and you have backup plans that God forbid something happens, that you're not working for a month or two, there is a way that you can afford to pay for your mortgage. So that interview is part of the process as well. Once your application is approved, we write to the Commissioner's office to seek approval for the mortgage. We are required to do that because we're a credit union. And then after that, we go towards the closing documents, signing your closing documents, and then the balance of the funds paid to the vendor. So that essentially is our mortgage process. Now, on average, mortgage process can take anywhere from 60 to a maximum 120 days. Most of the time it is 90 days. 120 is usually if an extension is required. So if there's a further extension needed for like WASA approvals or town and country approvals and things like that, then the extra 30 days come in. But the 90-day period is the average period. I would guard members against realtors and developers who also try to rush individuals, because over the years there have been instances, you know, in discussions with our members. And again, this is something, you know, this is the part that you don't get in the banks. This kind of personal service is the part that you don't get in the banks, that you can call and have the discussion. Ms. Travely, the realtor is telling me this, or the developer is telling me this. Can you guide me? There have been instances where I've said, hey, what, give me the realtor's email address or contact, and I'll have a conversation, because there are times when developers or realtors try to push the clients to sign a sale agreement quickly or pay a down payment quickly. Don't do anything that you're not comfortable doing. And always make sure that you check your documents, have the external attorney review your documents, check with us. Don't hand over money just like that, because anybody who is telling you, I'll give you a discount if, you know, we close this in 2 weeks, that's a red flag. Something might be wrong there. On average, this title search and evaluation takes about 2 weeks. So anybody pushing you to sign under that time, that's a bit of a red flag. And I always encourage members, don't allow, I should say guard members against allowing realtors and developers to push you to pay out money so quickly, right? In terms of our product, so this is essentially just a profile of our mortgage product. So we do give mortgages for the purchase of property. We do give mortgages for the purchase of land. If you're purchasing property, it is what you need to have on shares is 10% of the amount that you want to borrow. If you're purchasing land, it's 15% on the amount that you want to borrow. We do have a tiered interest rate. So based on the amount that you are borrowing, there we have the rate, and it is on a reducing balance. So that means that every single month your interest becomes less and less. The last bit here is a bit of the highlight, that you have all of 3 costs and still a very reasonable cost. The valuation fee is a cost to the member, right? It is minimum $2,500. Maximum, well, it would be, there's a formula. I can't tell you the formula, but there is a formula the evaluators use to come up with the fee, but it's minimum $2,500. And that valuation report is important because it tells you the value of what it is you are purchasing, and it also helps us know what is the value of the asset that we're going to be holding as collateral. The legal fees, all legal fees are discounted. Our attorney discounts the attorney fees and the legal fees. And the legal fees capture, if you ask our attorney to handle this, it will capture the review of the sale agreement, but it does cover all the searches. It covers the deed of mortgage, which is the agreement between you and us that we are giving you this money to buy the property, and you will be repaying based on a certain amount every month for a certain period. It covers the deed of conveyance, which is the transfer of ownership from the seller to the buyer. It also covers the instruments of charge, as well as any other legal documents required along the process. And those additional documents would come up if something comes up in the search. So for example, if it's if when the search is done, it shows a probate was done and something needs to be rectified, then there's a deed of rectification. So those additional things come up when the search is done, okay? And then there is the life insurance. Now, again, this is also something that, you know, COVID taught us, that life is very fragile. And we don't ever want to be in a position that a member has passed away and we have to go to a family and say, well, we have to take the property because it has to pay for the balance of the mortgage. So we encourage members to take out the life insurance. We do recognize that life insurance comes like an additional monthly bill, so that we do give members the option. If you have your personal life insurance that you want to assign, you do have the option to do that, but just keep in mind, if you're doing that and something happens, the insurance would come to the credit union instead of directly to your family. Of course, we just take the balance and the rest goes to the family. So you have that option, but you are required to take out the life insurance. We're very proud to say that up to now, we do not have the administrative fees that the commercial banks have. So we do not have processing fees. We don't have the credit report fee. And you know that big one, which is a percentage of the mortgage itself, that's the negotiation fee. We do not have any of that. So that, yes, you might see a bank offering you 4% or 3.75%, but bet your bottom dollar, 1 year down the road, they're going to increase the interest rates, and you're probably going to have a whole set of closing fees and all of that. Whereas your credit union, we do not impose all of those fees on you. And you know, it's a really big difference in that with the commercial banks, they work towards making that profit to be able to pay their shareholders a good dividend who may not be their customers. At the credit union, we work towards making that profit to be able to pay our shareholders a good dividend, and our shareholders are our members, so that we give everything we earn, we give it back to you, our members, as well. So there is a big, big difference between the two. So we're going to look at a couple of scenarios, and these are just a couple mortgage scenarios, 3 different amounts, one on the lower end, mid-tier, and a higher end, so that you can see what an installment would look like, and you can get an idea. You can get an idea, sorry, of what the legal fees look like. I know the image is slightly blurred. When we put it up on the website, though, it should be okay, but I'll walk you through it. So this one is a mortgage scenario of you're purchasing property for $1 million. And we're using the same household income of $18,000. So in the earlier slides, the same age bands and stuff that we looked at, then we're using it here. So that a member is taking a 25-year mortgage for $1 million. The installment is $6,140 every single month. And you have the legal fees. So the valuation would be approximately $4,000. And you have legal fees approximately $18,000 at most. Because it's $1 million, if you're a first-time homeowner, you're exempt from the stamp duty. And then you would have your life insurance. That one we can't give you an estimate on because the life insurance quote is based on certain questions and whatnot. Then if you look at a 20-year mortgage, and again, same $18,000 a month, you have an installment being about $6,800. Your legal fees still being $4,000 valuation, about $18,000 in legal fees, and you still have no stamp duty. And then if you look at a 10-year mortgage, you see the installment being a good bit more, $10,800. So again, this is also driving home the point of if you're taking mortgage in the later years with a shorter mortgage duration, you would find your installments being a higher one, right? And I also specify down here what the legal fees covered. So first-time homeowners, you are exempt from stamp duty up to $2 million. So that is dependent. And when you say first-time homeowners, you're referring to persons where your name has never been on property. So I think if you have inherited property and all that, you are not a first-time homeowner. It doesn't necessarily mean that you had purchased property, but if you inherited property, you're not a first-time homeowner. So it would be only for first-time homeowners. The next scenario is 1.5. So this one, we're looking at a monthly household income of, let's say, $22,000. So a 25-year mortgage, you're looking at about $8,000, just under $8,800 a month. And we've got valuation and legal fees coming up to about $25,000. It's under the $2 million. If you are a first-time homeowner, no stamp duty, right? And again, if we go along 20 years and 10-year mortgage durations, you find the installment being much higher, again, because shorter duration. And then the last scenario here is the $2 million. So if you're looking at a household income of about $28,000, in all instances, you got to have your 10% down payment on your shares. So in the first one would have been $100,000, second one $150,000, this one, sorry, $200,000. And you would find for a 25-year mortgage, the installment being about just under $11,700. And you've got the legal fees being just over $30,000. And again, if you're a first-time homeowner, then you do not have stamp duty here. Stamp duty is actually the big ticket item with the legal fees. So it is always a great benefit when you are a first-time owner, capitalizing on this. Now, I do want to stress as well with the first-time home ownership and the stamp duty and all of that, if you are buying property that is over $2 million, let's say it's valued at $2.5 million, and you are getting it a steal of a deal, $2 million, and you're a first-time homeowner, it doesn't mean you're exempt from the stamp duty. Stamp duty is based on the value of your property. So you will still have some stamp duty to pay because the property is valued at 2.5. So you've got to keep that in mind as well. It's not, or the stamp duty isn't based on the selling price, but it's based on the actual value of the property, right? In terms of the documents that we ask for, and most of these things, this is not unique to SECU. These are documents that would be asked for in any financial institution if you're looking at a mortgage. 2 forms of valid identification, so that's ID card, passport, or driver's permit. Proof of address no older than 3 months. We generally prefer a utility bill. Job letter no older than 1 month. If you have recently changed jobs or something like that, we would want to see a history of employment before that as well. Okay, last 3 months pay slips. If you do have additional income, then that can be added in as well, because then that would also go towards household income, so that we are comfortable that, okay, this installment can come out from your main salary, but there is also household income available here. If you are taking this mortgage or you're applying for mortgage with a co-signer, then the same information, you as the main borrower has to submit, the cosigner must submit as well. And cosigner could be, so a husband and wife taking a mortgage together, right? It would be nice if both persons were members of the credit union, but there are instances where one party might be a member and the other party isn't a member as yet. We encourage the spouse to join, but we would consider both incomes together as household income, right? The draft sale agreement. So the first three things that we would ask for to get the ball rolling is the deed and cadastral for the property and the draft sale agreement. The deed and the cadastral for the property allows us to get the title search and the valuation report done. So that is sent really on your behalf to our attorney and to our evaluator so that they would start that process. And that takes about 2 weeks. And while that is being done, the draft sale agreement should be reviewed. Again, we recommend that you either have your own personal attorney review that agreement, or you can, at your cost, have our attorney review that agreement for you, because it really is to protect both you and the credit union before you sign. Other documents that we would ask for: land and building tax receipts, last WASA bill, WASA clearance, last TNTEC bill, town and country and regional approvals. There are lots of developments going up now where they're taking very, very long to get those final approvals. And they're saying, well, no, you can occupy, we'll get the approvals after. No, it's important that those town and country approvals come in, because it means that structure is legally approved to be built there, right? And it is sound. And then if you're looking at construction, so if it's a situation where you own land and you want to do, you want to build your home, so we would do a mortgage in that instance. That would be a construction mortgage. Estimates and approvals for the construction or major renovations is what we would ask for. So this is just a basic checklist that we would ask for. Now, there are items sometimes that might not be on this checklist. Those items would come up if, again, when our attorneys do the title search and they see certain things. So if let's say you're buying property and the property is in the name of a company, the attorney will say, okay, we need certain documents that are related to the company that owns the property, that kind of thing. So the additional items come up based on what we see, what is seen in the searches. But this is really the main checklist that we have. So the benefits of financing your mortgage with SECU, and I think I touched on some of them along the way. One of the main ones, and sometimes members don't realize it, and they're pleasantly surprised when I tell them in the consultation. So that down payment, that 10% down payment that we're talking about that has to be on your shares, that's your money. It stays on your account at SECU. We don't take it and put it anywhere else. And that money continues to earn dividend every single year, and the dividend is put on your shares. So that your down payment, while you don't have access to it, it's still earning money for you. And when you are finished paying off your mortgage, that money is going to be sitting there, plus dividend for the past 20 years or however long your mortgage was. And that's there for you. So it comes like deferred savings, right? So you're getting that competitive return every single year. That's something that you definitely don't really get in the commercial banks. The hands-on guidance from the consultation straight to closing. It is something that we pride ourselves on, the personalized service, especially with the mortgage process, because I've come across so many members where they've started the process and they thought they knew everything about the process, but in going through, they realize, okay, no, they didn't know this, they didn't know that. And just having the comfort of being able to call someone and ask a question and get a response and not get some automated email or a voice recording. It's so appreciative. Or even instances where, yeah, you might have developers or realtors kind of pushing the client to sign a sale agreement or pay a down payment, having someone at the credit union to talk to guide you through, to intervene if we need to intervene, to help get our attorneys involved, that things like that. Members appreciate that. They appreciate that service. They appreciate us being there with them throughout the process in order for them to achieve their home. I can guarantee that is not something that you get in many other financial institutions. It is a one-stop shop experience, so that when you come to us, yes, we do recommend that you still have your independent attorney to check your sale agreement. But if you opt to use an attorney on our panel, then that's no problem. So they handle all the legal stuff. And we do have our panel evaluators as well, so that we can make the arrangements on your behalf to get things done. We even have different insurance options. So we have contacts in the various insurance companies, and we even have the option of the CUNA Advanced Protector that you can use for the life insurance option, so that we make it simple for you, that you don't have to go looking everywhere and contacting persons to get quotes and get options. We make it a one-stop shop for you. We do offer competitive interest rates. As I said, you know, yes, you might, and I'll be honest, you might look and see commercial banks offering 4% or less. But part of that is a marketing gimmick, because 1 year after, they are invoking the variable interest rate clause and they start taking the interest rate up. And by the time you finish paying your mortgage, the interest you're paying or the interest you've paid is much more than if you come to the credit union. In addition to which, we don't have any of the fees. There's 3 basic member costs, but all the other fees, there's nothing. We do have very flexible repayment terms. So in all our mortgage agreements, we do build in the option for annual lump sum payments so that you can accelerate your mortgage a bit, which in the long run brings down your interest. So we do allow at least 1 annual lump sum against principal every year, but we build a schedule into the loan agreement. And our legal fees, the attorney fees itself, are also discounted. So there are lots of benefits to financing with SECU. As I said, in my opinion, one of the major ones is that guidance that you get straight throughout the process. I mean, I have had consultations with members where the first consultation was 2 years before they even took the mortgage. And you know, they had one in the second year, and then they were like, Kelly, we're ready to do this. And I still held their hand straight through the process, and they were so appreciative. And there is a certain amount of joy that, you know, we at SECU feel when we take the member straight through the process and we're able to see them through the signing, and they get their keys and they have their home, and they're so very happy. And they tell us, you know, if it wasn't for Cannings, this may not have happened, and they're so appreciative for that. And I mean, that brings us a lot of joy as well. So I'm at the end of my presentation. So we're going to be entering the Q&A session soon. But I encourage members to book your consultations, and you can do it. You can just send us an email, info@mysecu.com. I generally book consultations about 3 days during the week, during specific times. And I'm flexible. If you want to do an in-person consultation, which is now in the minority, I can do an in-person consultation when you come to the office. But we offer the virtual consultations so that you can do it. You can do that consultation at your convenience. You don't need to leave your office, that sort of thing, right? But I do encourage you to book the consultations. You don't need to be ready to take a mortgage tomorrow. you can be in the process where you're looking around and you need guidance. So you want to find out, well, how much do I qualify for? How much would I qualify for realistically? Or I'm looking at, planning to take a mortgage in 5 years. Can you help me figure out how to put together my plan, how much I should be saving, things like that. So it's different types of consultations, but it's all helping the members and educating the members on, how to achieve home ownership. So Asha, I now turn things back over to you as we enter the Q&A session. Let me take off the presentation.
Okay, thank you, Kelly, so much for that informative presentation. I find it very intriguing and exciting because I myself kind of hoping that by next year I could be able to take a mortgage as well and get my own home. So definitely it is going to help me, the information here today. And well, at this point in time, I would like to open up the floor. I want to ask members if they have a question, they can put it in the chat or they can raise their hand by clicking the little raise hand icon here, right? And we will unmute your mic and you can proceed to ask your question. So whilst we wait to see if anybody puts up their hand or types in a question, Kelly basically covered everything. I had some questions I wanted to ask and now I don't have any questions.
I'm very sorry, Asha.
I guess the only thing that might be applicable, if in case, like for persons who want to have early repayment on their mortgages, what are the terms that we can offer for like lump sum payments? Are they allowed?
Yeah, so we do that in every loan agreement, mortgage loan agreement. We build in a repayment schedule. So outside of your regular monthly payment over the duration of your loan, whether it's 10, 20, 25 years, we build in a schedule that allows you to do a lump sum payment, just one lump sum payment to principal each year, not more than 10% of your balance. So if your balance is $1 million, then you do have the option of up to 100,000, but in one lump sum payment, right? And then in terms of the early repayment, no full early repayment as in pay off mortgage before 5 years.
Okay. So if they would like to pay off before 5 years, a penalty will kick in.
Yes, that's correct. Because at the end of the day, you have to recognize it's still a business, and we would be projecting a certain amount of interest income over a certain period. So allowing the payoff so early, it would affect the business. Yes. I'm seeing a question from
Shadi.
Yes, so Shadi, yes. Would it be more difficult for recently self-employed persons who have the down payment in their shares? So I wouldn't say difficult. It's just it's a little different. Generally, we would look at employment, at least consistent employment for at least the last year. Self-employment, yes, I will admit, is a little more challenging because you have to now provide proof of income, and proof of income for a self-employed person, we would ask for registration of the business. We would ask for simple financials. We would ask for bank statements for the last year, invoices, things like that. So I don't want to tell you it's more difficult. Yes, it is a little more challenging in terms of the amount of documents that you would have to provide. But we would look at, I would say, you've got to be able to show generation of income, consistent generation of income for at least a year before we would consider it. Yeah. But you can always reach out to me and I can have a further discussion with you on it. That's not a problem.
Yeah, because I guess it would be more or less to show ability to repay the loan.
Yes, that is correct. That's correct.
So we have a question from Shana Fraser. She says, I have been hearing that TNC, Town and Country, and regional approval is not required for properties older than 4 years. Is this true?
Definitely not for not 4 years. It's much longer than that. If I'm not mistaken, it's about 10 years and more. I'm trying to remember. Now, I'm not an attorney, so I can always get that information confirmed and give you the information. I'm just trying to recall a mortgage we did recently where the realtor was fussing about the Town and Country. And I believe the attorney said if the property, if it was more than 10 years or 15 years or something like that, then you may not need it. But what you can do, Shana, just send us a little email so I have your email address and I can confirm that with the attorneys. So I could give you a proper response. There is a time period in terms of the age of the property, but it's definitely not 4 years. It's a lot longer than that. Because 4 years is generally new. So if it's generally new, then yes, Town and Country and stuff would still definitely be required.
Okay. Thank you. All right. So not seeing any hands raised, but one question also. Okay, look, we have somebody, Zubi, I can't pronounce his last name. What is the process for refinancing, and would the interest be the same?
So if you have an existing mortgage with the credit union, yes, we would look at refinancing. It would be subject to, again, all the criteria, ability to repay. We would look at age, employment, all of those things. I would have to, I can't say yes or no off the bat on the interest rate. I would have to look at the individual, the individual case to see if that interest rate would hold. I could tell you more than likely, if this is an older mortgage that you're looking at refinancing, the interest rate might be lower, not higher. Because the older mortgage were at a much higher rate. The mortgages of the last 10 years have been on the lower rate. But yes, we can look at refinancing. Now, as I said, it would be based on how much of the mortgage has been paid off already. Because depending on how much, then that creates equity in the property, right? So again, I suggest this one in particular to send us an email and we can have a discussion. Things like the down payments and all that would still hold. You would need to have your down payments and all of those things. If it is something that you would have taken a mortgage with us, so we're already holding the property, then it would mean updated valuation. You may not have much legal fees to pay, but definitely valuations would have to be updated. But we would have to assess the ability to repay and debt service ratio and all of those things.
Okay. There was actually a member in the office today, and she was inquiring about whether or not if she has land and she would like to use the land as the collateral rather than having a down payment, if that is something that SECU would have facilitated.
They own the land free and clear?
I believe so.
If
I
the
told her
land,
I'm hoping she's here on the seminar, because we sent her the link. I think I can't recall the name exactly, but she was inquiring. She said she owned the land.
And she's looking at constructing?
Constructing. So she wanted to know if the land could be used as a collateral.
So if you own land and you own the land free and clear, right? So no mortgage on the land at all, it is fully in your name, no debt on the land, then yes. Now you would always need to have some shares in the credit union. We would never grant a mortgage where we just hold in the land. But you may not need to have 15% of the amount you're borrowing. It'll be a smaller amount. But yes, we can use the land as part of the collateral together with a smaller amount on the shares.
Okay. So Tremaine Andrew has a question. If you have a current loan with SECU, but you happen to get the opportunity to purchase a home, would you be required to finish paying the loan before applying for the mortgage?
It depends. It really depends on how much. So it goes back to debt service ratio, because you'll be paying a personal loan and then you're looking at applying for a mortgage. So that's two
Yeah.
different installments, two amounts that's being paid. So in terms of debt service ratio, based on your monthly income, your monthly take-home income, if you are within the debt service ratio, then it would be fine. The other thing too is if you've got a current loan and it is pledged against your shares currently, it means your shares are the collateral for your personal loan. What that means is if there isn't any excess, then we have no collateral for the mortgage. Because remember, when you're taking a mortgage, if it's purchasing property, 10% of the amount of that 10% of the amount that you're looking to borrow should be on your shares, free and clear. Those shares shouldn't be tied to anything. So it really is dependent on the balance of the loan, how much you have on the shares, whether there is excess shares, how much, and also the debt service ratio, whether you can accommodate it.
Okay. And so Shauna asked, can life insurance also be used as collateral?
No. So the life insurance, it's really, so that's in the event of death that pays off the mortgage. We wouldn't use it as upfront collateral for, it would, because let's look at this scenario, right? God forbid you lose your job and you can't pay the mortgage. Life insurance isn't going to kick in because the life insurance only kicks in upon death. So life insurance on its own it can't be used as collateral for the financing of the mortgage. The life insurance is really, in the event of death, there is the insurance that will then clear your mortgage. Yes.
Correct. Because technically it's not an asset, so it really can't be used as collateral.
That's correct.
Okay, so do we have any more questions?
I saw someone with their hand up. There are two persons with their hands up, Carlos and Aruna.
Oh, okay. Well, I probably didn't see that. So Dava could probably unmute the mic.
Yeah. Oh, yes. I'm seeing Carlos's question here. So how will SECU deal with if I have a loan for land with a bank but want to build a house and have the shares in the credit union? Okay. So, so if you've got a loan with the bank for the land, and I am assuming that there is still an outstanding balance on the loan is still being paid, then the bank is holding the land as collateral. So that if you want to build a house, even though the shares might be in the credit union, we can't give you a construction loan because we can't hold the land because the bank is holding the land. What you might have to look at there is actually, now I don't know how far into the mortgage you're in. You might not want to say that right now, but depending on how far into the mortgage you're in with the bank, the option is moving that mortgage across to the credit union. And then we can look now. Oh, only 2 years. So I could tell you off the bat.
Penalties.
Yeah, the bank's gonna hit you with penalties to move it. The bank will hit you with penalties to move it. The other thing that we have to look at is what's the value of the land and how much has been paid off, because depending on, we need to have at least 50% collateral backing when it comes to construction mortgages. So when you own the land free and clear, the equity in that land is there. So we can use the equity in the land plus what you have on your shares to give you money to build your home, right? But if you are taking, or if you have a mortgage where you finance land, it means you're still owing on the land. So you haven't paid off a substantial amount of that land, meaning we don't have as much collateral to hold. You follow? So that yes, one, I could tell you the bank will penalize you for trying to move that in 2 years. But that would be one of the options. I would also say that building right now may not be an option because you would have to pay down a bit more on the land to free up that equity before we can consider giving you money for construction, because we actually don't do bridging. So that's bridging. Bridging is when, and the banks do the bridging. So they give you money to buy the land, and then I think a year later you build. And I believe that for one of those you pay a higher rate, or you pay a higher rate during construction, something like that. So we don't do bridging at the moment. We only consider those scenarios when the land itself has been either fully paid off or substantially paid down on. So if we're looking at 2 years, I know off the top that that's not substantially paid down just yet. But I mean, we can still have a further conversation on it if you wish. That's not a problem, and we can look at some different scenarios.
All right. So, Aruna.
Yes. Hi, good evening, all.
Hi.
Good evening.
I have 2 questions. One is with regards to the age. Now, on the presentation, you had said up to age, the retirement age. But is there a possibility that someone at retirement age and meeting all the other criteria can take out a mortgage loan?
That one would have to be on a case-by-case basis, simply because what we're looking at there, so when you reach retirement age, your monthly income decreases substantially. And that's why we use up to retirement age. So I know I use 60 because it's a national retirement age. Some companies it's 65. So if it's 65 in your place of employment, then we use 65. When you pass retirement, what then happens is that your monthly income is no longer what you would have been earning monthly during your working years. Your monthly income now comes down to a combination of pension from your employer, NIS, and whatever other pension there is that you would be entitled to in the system. So I'm not saying that we don't, but it would be something we would be very cautious with, because you might have the 10% or the 15%, but we wouldn't want to put a member in a position where in your retirement years, that big chunk is coming out from mortgage payments, because we also have to look at things like, and I mean, it is a reality. This is not us frowning on age or anything like that, but it is looking at thinking about our member and protecting them in those years, because in the post-retirement years, you're getting older. Health-wise, health begins to decline at times. Things happen where money might then need to be used for healthcare or other things where it might then be tied up in a mortgage. So it kind of puts the member into a particular position. So I remember mortgages, you're looking at 10 years, 15 years. As much as you might have the down payment, or you might even have a lump sum. If we are looking at doing a 10-year mortgage after the age of 60, and we're restricting that to 10 years, the installment might actually be, depending on the amount you're looking at, the installment might be higher. But again, we can have the discussion, we can look at the figures, I can look at the figures with you, but it is something that, we're very cautious when it comes to after retirement.
Mhm.
I would appreciate getting a consultation because
No problem.
I have different things in mind. My
Okay.
other question, and I'm
Yeah.
not sure if you have any experience with this, is that recently I've been seeing a lot of developers offering purchases of land, but it's only on a cash basis. So
Oh
in these
boy.
cases, there are no tongue and country,
Hmm.
that type of thing. Have you had any experience with that? And how
Yeah.
do you think that is really something that one should get involved in?
Hmm.
So I always remember when we had our attorney do part of the webinar, like the legal aspect, she always said, when someone is asking you to buy land cash, that is a red flag.
Yeah.
I hear what you say, Aruna, because just recently I was dealing with a member where, and a very young member, she's looking at buying land to build her home and all of that. And the developers are rushing her
Hmm.
to pay cash and actually telling her, well, we'll give you a discount of how much of $1,000 if you close in 2 weeks. You have to be careful with things like that. One, cash deals, cash land deals are dangerous because you're not too sure about the title of the land. Additionally, if they don't have approvals for the land and you then buy the land and you want to construct later on, you might be caught in a position where you have land and you can't do nothing with it because there are no approvals for the land.
Mhm.
So it's not something that I would recommend. I would always recommend, and I stress this to members over and over and over, make sure that a search is done, because what the search does is it will highlight if the person selling the land can legally sell it. If that land, if anything is wrong with that land, all those things will be highlighted, do a valuation. And above all else, don't just hand over cash or a check like that. Things should be done legally through a sale agreement and all of those things. But I have noticed, yes, that there are a lot more developers coming up and saying, yes, we have land for sale, cheap land for sale, and things like that. And you have to be very, very careful with those things.
Okay, thank you.
You're welcome. But Aruna, send us an email, info@mysecu.com, expressing your interest for a consultation, and we will schedule you because we can do a visual.
I might not be able to do that until July, so but I'll send the email.
That's right there.
That's no problem. We can schedule you in advance.
All right, thank you.
You're most
You're
welcome.
welcome. So we have a question from Precious. She said she probably missed it, but what's the take on gated compounds and the HOAs?
Don't think this is a silly question. What's HOAs? What are we referring to with HOAs? I'm not sure what HOAs mean. When you
Gated
ask what is
compound.
my take on gated compounds, is there something specific that you're asking? If you could just expand on what it is you're asking. While
Well,
we're
I guess
waiting,
sorry?
I was going to say, while we're waiting for Precious to
Yes.
respond,
there's
I saw
Deborah.
someone else. Yes, Deborah had her hand up, so we could
Deborah.
probably look at Deborah while we wait.
Mm-hmm. Deborah?
Deborah there.
Yes.
Okay.
Question.
Hi, Deborah.
With regards to mortgages, as you were speaking about at retirement, do you all allow children to take over the mortgage? Is that possible if the children are part of the credit union? Can they take it over after you reach 65 or something like that, seeing that they are young and would be working?
So what we actually encourage is not at the end stage, but we kind of, if the children are younger and they are gainfully employed and all of that, what we encourage is that the children and the parent can take the mortgage together, where the primary borrower be the child. But again, we will also look, I mean, I always put in the disclaimer there, we always have to look at the income and the down payments and the ability to repay and all of that. But what we guide the members to is to consider, yes, if the child, if you want the younger person to be the primary borrower and you be the co-borrower, then we could look at it. But again, we have to consider things like with the parent, how far off from retirement is the parent? Because it's little things like, for example, if the parent is 1 year away from retirement, but you're looking at doing a mortgage, but putting it on your child's, and your child who is employed and all of that, young adult, having them be the primary borrower so they get the longer period. If we are considering combined income, so the two incomes, yours and your child's together, to assess debt service ratio, and you're retiring in a year, then that might be a problem. Because after that year, what's going to happen? Your income isn't going to be there anymore and things like that. So,
okay, so if it's like a period of like, say you're 55, and you're probably going to retire 65, so you have about 10 years.
You have a 10 years, so yes, we can look at something, yes. Those things will make a difference. So we can look at it. But yeah, the short answer there is yes, we can.
Okay.
We can look at it. I think you should be one to book a consultation so we can have more of a discussion to see what the exact scenario is and work out the details to see if it is more possible.
Okay, great.
Right? But yes, we do look at those options.
All right, great. Thank you.
You're welcome. I got clarification for Precious Homeowners Association. That's what HOA stands for. But I would like her to just kind of clarify for me exactly what she's asking.
Yeah. She has her hands up so she can.
Oh, homeowners fees for maintaining property in the area of gated communities. Well, okay, so in almost all developments, there are maintenance fees, and you have to appreciate. So we see a lot more gated communities coming up. Actually, when you talk with realtors now, you find more people gravitating towards gated communities and developments where you have that hybrid option of you have some standalone houses and then you have some condo type living, but all in the same gated area, simply because a lot of people now a little concerned about things like the crime and whatnot, so they're not comfortable with with purchasing a standalone house. You've got to appreciate that with gated communities, there are facilities that are provided that wouldn't normally be provided if you had your standalone house. So things like communal pool, entertainment areas, gym, tennis courts, all of those things. Those are now being included in these gated areas. And those things do require maintenance, so that it is totally acceptable for maintenance fees to be charged after you've purchased a property in a gated compound and whatnot. It is acceptable for maintenance fees to be charged. I cannot elaborate on the extent of maintenance fees because I wouldn't be able to speak to that because I do know some maintenance fees are quite exorbitant.
Yeah.
But again, it would be based on what facilities are accessible to persons that are living in the compound. You're welcome.
You see, Avalon stepped in and helped out this situation.
Yes, I just realized I was Avalon. Thank you very much, Avalon.
Yeah. So does anyone else have any questions? Let's see any. Wow.
I'm not seeing anybody.
Yeah. Last call, any last questions?
No.
No?
Well, even if you say, oh, Deborah is raising her hand again.
Deborah?
Mhm.
Deborah, you can go ahead.
Yes. I wanted to know if this session was pre-recorded. Is it
Yes.
recorded? Yes, so we'll have access to it.
Yep.
On the
Asha
website.
will
would you get
explain
access?
exactly where it is.
Mhm.
Okay, great.
And when Asha is doing her roundup, she will tell everybody where they
Where
can
we can
access the
access it.
recording as well as the slides.
All right.
But
Yeah.
I do encourage members before Asha does the wrap up. I do encourage members that who have attended, if you are thinking about home ownership and whatnot, I encourage you to start to book your consultations. Yes, you might have persons who are ready to take the mortgage, but then you also have those where you're planning for it, and sometimes you need that guidance in the planning stage so that a couple of years down the road, you're ready to take that mortgage and hopefully ready to take that mortgage with your credit union. Because at the end of the day, your credit union does have your best interest at heart. I cannot say the same for a lot of other financial institutions, but your credit union does have your your interest at heart.
Okay. Okay, so are there any more questions? That's it? All right, everyone. Well, thank you very much. Yes, just to reiterate what Deborah. Oh, I see two more hands up.
Yes, two hands popped up very quickly.
Let's squeeze it in. Let's squeeze it in. So Dominic, you want to go first? Dominique? Dominique, you don't want to ask a question?
No, sorry, that was a typo. Sorry about that.
Okay. I see
Okay.
another hand up.
Office 365. I
We
don't
don't
know
have a
who that
name.
is.
Yes, we don't have a name.
Do you want to? Okay.
I have a question that came in separately, and
Yeah.
it was that if there is the person's asking if there is a limit on how much you can borrow. So, for example, you have land and the contractor quoted for 1.7, but the bank says they will only lend you 1.2. But the contractor is quoting more because you have things like retaining walls and all of that.
Oh, something to build.
So there are a couple things that we look at in terms of how much we can lend. One of the main things is your ability to repay. So when we work out the figure for 1.7 and 1.2, we're also looking at 45% of your gross income, whether you can afford to pay it over the term, because we'll also look at your current age and retirement age. So the difference between your current age and I think somebody has their microphone on. No? Okay, right. Yeah, so we look at the difference between your current age and your retirement age, and that represents the maximum length of time that you can pay the mortgage. Then we will look at the debt service ratio. So we will work both the 1.7 and the 1.2 to see, okay, 45% of your gross income monthly, can you afford this? The next thing we're going to be looking at is value of the land, because we have to look at our collateral. What are we backing this mortgage with? So what's the value of the land? I'm assuming that the land is owned free and clear. So what's the value of the land? And then what is the value of the property upon completion? So when you are doing a construction mortgage, most of the time, the valuator can do a valuation, so a projected valuation. This is the land now with the property and the retaining walls and all of that. This is what it's going to be. Now, if the projected valuation is 1.7 or higher, and your debt service ratio is 45% or lower, and you have your down payment and there is enough equity in the land, then we would consider 1.7. We would consider less if we have the red flags of DSR or if we have that projected valuation saying, okay, well, structure and land is really only 1.5 value, then we can't go beyond the valuation, right? And sometimes we even come a little under that valuation in terms of how much we lend, so that it leaves a little wiggle room. So if the valuation is saying 1.7, we might say, okay, we will go up to 1.6, assuming debt service ratio is okay, and assuming down payment and everything is there, then we would come down a little bit.
Okay, thank you very much. I am seeing someone hands up for Office 365. I think the person who was trying to speak just now. Are you there? Would you like to ask a question? I heard something just now. Hello? Okay.
In the interim, I'm seeing a question popping up there from Nicole.
Nicole.
Do you have restrictions on the area that you can get a mortgage? No, we don't have a restriction on the area. What I will say though is that valuators have restrictions on areas that they will do the valuation. So to put it very plainly, high crime areas, we do have valuators on our panel that have said outright, we are not going to this area to do a valuation because of the high crime and the risk that is involved. So at the end of the day, we would require a valuation before we would even consider granting a mortgage, so that we would need our evaluators to do a valuation. So the credit union, Canning's Employees Credit Union, doesn't have a restriction in terms of area, but we may be restricted based on our evaluators being able to do the valuation in the area.
Okay. Right, so that's the final question there.
Is Office 365 able to ask a question yet?
Probably got cold feet.
I don't know.
Yeah. Okay then, well, I'm guessing that that's all the questions for now.
Okay, I have one more that just came in too.
Okay.
Yeah, we have some last minute questions coming in.
Okay.
So does SECU give loans for building on agricultural land? Yes, we do, because for agricultural land, you are allowed one residential structure. So we do allow it. Yeah, that's the simple answer. We do allow it. Yeah.
Okay. Okay, so if there are there any more questions? Well, if there are, I don't think so.
Yeah.
Well, thank you very much, Kelly, for facilitating this afternoon's webinar. And I am sure that our members have more clarity in terms of understanding the mortgage process, as well as what they need to prepare and look for, gathering in terms of documentation as well. And yes, just to reiterate, this afternoon session is being recorded, and you can access it sometime tomorrow. Give us a little time to upload it, but it should be there by tomorrow's afternoon. And you can hover over the section Media Center and Resources, and then look to see where the gallery is, and then you should have access to all our webinars actually. So you don't just have to look at the mortgage webinar, you can look at all the other webinars because they're all saved right there. Okay, so just a reminder also to our members, if you wish to book a consultation with Kelly, you can do so via info@mysecu.com. You can email us, or you can go to the website to learn more about our mortgage product. All right, so, well, at this point, we have come to the end of today's webinar. I want to thank each and every one of you for attending, and I do hope that this session was informative and helpful, and I wish you good night and God bless.
Night, everybody.